Well, it's that time of the week where we call on Robin Cross of StoneX. He's located in Chicago. And Robin, we're going to talk a little lumber action. And boy, I tell you what, for the last couple of weeks, this has been a very steep decline. And I remember, I think it was, well, on January 14th, I see we put in a high, 1338 on March lumber. Been downhill ever since. And are we slowing the descent today?
For sure. Good morning, Marlon. Thank you for having me. So, first of all, let's go through the prices. Right now, March is trading $986, down $22.70. 544 cars traded, massive volume. That's the more volume today, this morning, in the first 15 minutes than we had in the previous 6 days of trade combined, all months. So massive. And usually when you see this kind of volume on a major low like that, that usually means, it's probably a near-term bottom, right? So May lumber, which has been very active too, is trading right now at 917, up 980 with 101 trades over there. So, as you were kind of leading up in the segue, extreme volatility is still the, prevailing theme of the lumber market. And I just kind of wanted to paint a little picture over the past couple months what we've been going through, right? So November, if you remember, expired on a swing low all the way down to $530, right, on expiration actual November 15th. Then January flipped and did the exact opposite and closed on its swing high, 1,237, right? So it's a big jump, almost a 707 point gain, or a difference of about almost $80,000 a car, okay? And just one expiration to the next. And then finally we got March. March, if you remember, got up to 1338. At that time, January was trading at 1237. March was a massive premium, over $100 premium. And I'm always on here preaching about premium. That the market will converge, right? Talk about convergence. We went from a $100 premium to a $200 discount, but you got to kind of. It was pretty easy to see and super obvious if you just paid attention. When January was going up, if you remember, it was like 9 days in a row of limit up. Well, what happens with shorts in the market? They can't get out. So what do? You buy one of the deferred months to spread yourself off, right? So in this case, they bought March and May, watched the market go up. But one of the major mistakes I've seen for the last 25 years guys make, they turn that hedge, if you will, against a bad short into, like an investment. And you're not supposed to do that. What you do is when you're getting out of the front month, the one that you're bad in, you simultaneously take profit in the deferred because, you don't know what the market's going to hold. Obviously, you thought it was the right thing to be short and you had to do defensive measures to get out. So don't let those defensive measures turn into your investment. So we're standing around, we're at 1338, and, we called it on the air. Literally, it said the day after expiration, this market's going to break. And then, we're down for 8 straight days of limit down. It wasn't too much volume till today. Today was the really first day you've seen it. But the fact of the matter is, it was completely obvious because, you don't go from expiring at 530 in Nov to 1200 in Jan. You got to find somewhere in the middle, right? And that's what we're trying to do is we're trying to sort out prices. Because on one hand, you still got good fundamentals, housing starts and permits, which we went over a couple weeks ago, were really strong, actually in some instances better than expected. But at the same time, we know from going to 1700 last year that the market just can't stomach these prices. The guys put the PO books away and they look for a better deal. As they should. It's quite simple when you have the will of the buyer go away, then all of a sudden prices return back to reality. I do believe that we're getting close simply because of the reasons I cited, with demand being still good. But at the same time, you still got to be, cautious. And I consider myself a true fundamentalist, but in this instance, it was a pure technical trade. We violated the 20-day on this move, Marlon. That was the first time since November 15th we violated it. And then obviously you get stops and, protection under that. We violated the 50-day, got some more stops under there, and all that built up to today's low, that's where it was finally came loose and traded, and the other traders let the bad longs out of the market. But that doesn't mean that, the break is necessarily over. You have a lot of things hanging over the market with transportation, as we always talk about, so I don't want to beat that anymore. But, the saber rattling, there's a lot of things on the back of people's minds other than just buying and selling lumber. So I still advise caution. There's no way I would recommend for anybody to sell this massive break. If you really are in a situation that you're inclined to sell it down here, I would say go buy yourself some puts and save yourself the aggravation. Market's definitely getting a little overcooked, and, that's what we're looking at, good buddy.
Great information. And as you said, you pretty well pegged it here a couple of weeks back, warning people about that. So thanks for the heads up on that. And what a fall it has been. Thanks again, Robin. Robin Cross of StoneX in Chicago. We're going to pause here. We'll take a look at our livestock trade as we head to mid-morning after this.